My check.
Morning.
Good morning. Let's go ahead and mute everyone. Bam, 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 bam. Show the movie. Get this off the screen. Get this here. Put the chat over here. Okay. So morning again, guys. Today's plan is to essentially try to have a conversation or a discussion with the new guys and the old guys. Originally, it wasn't my idea, but I feel like the idea is very, very useful, in particular because I think on the last couple live calls, maybe 5 to 6 live calls or more, it's been more of just me trading and everybody just watching. No questions. And I personally feel like that's defeating the purpose of why I want a community. So the idea kind of amplify that feeling, and I feel like it was a good way to, one, rekindle my passion to share, rekindle my understanding of where everybody is. It's been a while since I don't get a lot of questions anymore. The questions I'm getting nowadays, it's not so much that curious spark that we had when we just started, where everybody actually wanted to trade, and I was giving questions around how to do stuff, what stuff meant. Nowadays, it's not so much of that, and that's kind of killing the vibe, so to speak. So I know that there's a lot of DMs I've gotten from the old guys or the guys that were with me in the beginning, and because of that, I feel like this would be a nice way to kind of catch up with the questions I missed in the DMs, and as well as kind of give the new guys some what's that word now? Motivation to not be shy. I don't bite. I don't judge. I'll never call you out for a question, whether it's silly or not. I'll never call you out for calling me out. I'm human. I'm not going to be the perfect mentor. I'm not going to be the perfect trader. So if I do something and you have an opinion on it, I don't have a problem with you saying, hey, that was a stupid trade or something like that, right? That's how we talk and that's how we grow. So now that that's out of the way, what's up with everyone? It's open mic season. Hey, Voodoo.
Don't go chasing waterfalls.
Oh, did some waterfall chasing last week. Wanted to see.
It's good, everybody.
This. So I was I had a very interesting question from somebody last week, and it was pretty much around when you look at the chart, like a higher time frame, how do you differentiate like what range to look at when you can find ranges within ranges within ranges? And what you see here was essentially my response in one of those classic "what do you see" scenarios. So I shared the empty chart and I started walking through how I would look at it. This is the biggest price swing. You mark it out. You see where we are in relation to that. We have other runs on liquidity inside that. We pay attention to the runs on liquidity. It's still inside the biggest range. So you're looking at internal liquidity. as well as the possibility for potential external liquidity runs. This is a breakaway gap. Expected it to stay open while we did all this madness. Got filled, bodies in here, good stuff, looking for them to trade lower. They did, swap liquidity, looking for them to dig deeper to set up a discount market for the election on November 5th. But it pretty much failed to get below sell side liquidity. And as you can see, built like a rejection block type of structure, pump above order block. So these three scenarios, it's not a if this then that. It's logically speaking without bias. If you look at the price action, these are the most likely scenarios to play out. We close the bag, we run higher. Simple. It runs above the bag, drops back down into the bag, finds support, pumps again. So that's the first green arrow here that says bullish. Pump above, come back, bullish. A delayed bullish would be to pump above here, setting the stage that it wants to go higher, but then it comes back, sweep internal, and then pump. Internal will sweep here, so maybe that's why we're not seeing anything like that. And of course, it could just be bearish, where it's already hit the bag here, and then it just, I think this was where we did the analysis, Friday or over the weekend. Just hit the bag, not going anywhere, and it just crashes. So that's what this is. Just a little bit more, not really, but nice view to have with the bag, the old range, quarterly opens. It's looking like it wants to use this as an order block. If you're a big fan of I don't know what month it was. It's either 4, 5, or 6. Somewhere in there. When Ice-T was talking about the order in which PDRA sprint. Old high, old low, rejection blocks, order blocks. Yeah. So yeah, that's enough of the ranting.
That's month 7, Kish.
Yeah, one of those months. I know it was somewhere in there. One of those months. I know 5 was the interest rate stuff. I don't remember what's in 6. I think 8 was more day trading related. I know 10 was equities. I really only pay attention to the first 4 months, if I'm being honest. I watched most of the rest after I became charter. But yeah. So, where's the questions? Send them my way.
Who wants to start?
I don't know.
Wait, all right, I got you. Hold on, let me get my notebook.
How's your day been? Saturday morning, I was supposed to hang out with the guys last night. Every other Friday, we try to meet up and kind of unwind, get out of the market, talk about life, kind of ground each other. But it didn't work out as planned yesterday. Some of the guys weren't feeling well. So I kind of just sat with some friends, tried to enjoy the music, get it out of my head. And got home about 4, went to bed, woke up back about 6, 7, thereabout, maybe 8, not sure. My son is here, and he's a menace. So most of my morning was chasing him, literally. He doesn't stay. So I've been chasing him around the house, outside, and then went to bed and kind of had a makeshift breakfast. So I don't come on the call dying. So yeah, can you go over how to find and determine a directional candle and what makes that directional candle? So when you say directional candle, there's only one thing that comes to mind, and it's right after a void fill. We generally want to see the market expand away from whatever the range is. So if I go to a clear chart and we say this is the open price of a delivery, could be an 84-minute cycle, could be some higher time frame cycle, it could be just a regular candle. We know if it expands higher, that's inefficient. So let's say the market's doing that. When it comes back down here and that's filled, generally, let me close that. We're now looking at this portion of the range as efficient. This is an efficient range. So now, if it's an efficient range, context tells us that markets have no business staying in an efficient range unless it's been held. If that's the case, then ICT month 1, elements of trade setup. This condition is consolidation profile. We pay attention to 50%. And we try to think about premium to discount for as long as this range will hold. Okay. So if the range is large and we're in the discount portion, you try to frame a setup that's at least 20 points to the equilibrium. So you can get out or go break even and then watch it at 20 or equilibrium. If this is a market that should be expanding because there's volatility, its equity is open, there's something that says this market has no business going up here, or maybe there's a key level here and we did this and printed a nice little dealing range. Then you can start framing a directional candle to say that this is the candle you want to see get used as an order block. So if it's an efficient range and it's going higher, there's a high possibility that let's put an up candle here, for instance. If that's an up candle, range low, you're bearish. If you're bearish and right after the delivery gets rebalanced and the range is efficient, seeing the market hit that, normal. What's not, I guess, what's that word? Clear to see is sometimes you want this to be an order block, so you start trading it early, or you see it go all the way back inside here and you want to go long or something, or you miss the ideal entry. It drops here. You try to buy something inside here because maybe it's a slow delivery. You get stopped out. When you have whatever the level is that you identify and you use rules to identify it, you have to let go of this idea that they cannot go above the high. What you don't want to see is them expanding above the high, because this could be an OLR and then it runs and then life is good. You're getting in here because you're watching this push and you want to see them trade below here to get a CSD. It doesn't happen. You're watching this, and you change your bias here. You start buying retracements. Stops you out. You get upset and you go. So if this is what you meant in terms of directional candle, then that's how you identify it. Wait for the end of the delivery. The new delivery should tilt its hand, air quotes, and then you start framing. If this is the level I want to use to make a decision, what do I want to see at this level? It can't be, it's an old high, it's an old low. I'm going to buy, I'm going to sell, just because. Remember, what we do when we're trading is not move the markets. It's read the delivery, interpret it, then make a decision based on that interpretation. So if this is the order block, you should be thinking, okay, if it's an order block, this is how price should deliver. We should try to get below its low. We should try to retrace. We should not try to go back above a 3-bar high, stuff like that. And slowly that starts giving you confidence to trust that a retracement is just a retracement and not a change in order flow. Similarly, if this is a down candle and you're bullish, don't be afraid to see them take the low to build up, sweep all the built up liquidity there, and then da. let's see, where are we? Should we go with avoiding here? No. Why not? That's Siri. Why not? Check your text. If that's I think there's two Akash in the group. If that's the Akash I'm thinking, I tried giving you a FaceTime video call yesterday.
Wait, what? There's another. I have a
Yeah,
clone.
yeah. Like I was scrolling through my Telegram and I saw Akash. I'm like, who's this? Because DP wasn't there, and I checked and there was a full-blown conversation between me and this.
Oh,
But
a whole other person. I didn't get any calls from you yesterday, so
you didn't? Okay, all right, never mind.
yeah, just call me when you can.
Cool. Voodoo, I don't miss that phase where they learn to walk and run so they do not. Yeah, it's something that's more common with newer traders, where you feel like what you need is more information. So you get more information, and then shiny penny syndrome just takes over. And you just start running with it. You don't revise or like, maybe you don't journal. So you don't get to experience that period where you think you know something, then you actually learn later, and you go back and you're like, oh, this is what I was actually learning. And then you put it together and then eureka, running through the streets. We don't get much of that anymore. Teak is one of the last persons. I think Akash too. Teak and Akash are probably the last two persons Stray recently to have that based on what they've shared with me. How do you identify conditions where you were more likely to be wrong? For me, I feel like I'm more likely to be wrong when, how do I put this? When you get to the charts and you see something, and for example, let me show you. Let me show you something. I'm not sure if I was wrong yet, but Friday, my entire plan was see the market trade above here. In particular, yeah, okay, about the same place. See the market trade above here. So Friday started, Friday 8 a.m. at least. There. So inside here, we'll just put a line for the open of the air quotes trading day. Inside here, my entire premise was to see this market trade higher. So when you go to lower time frames, I'm long. Like I'm long. And it's just not going anywhere. And at some point, I'm like, you know what? I'm done. And I just left. And left the runners. But in these examples, when I'm bullish, for example, and you know that in bullish environments, you're getting up candles, then you're getting the market close above up candle highs, and then you're getting the market close above that up candle, then you're getting breakaway gaps. In environments where that's what makes the market bullish, and if we just pause and look at this, reading from here, roughly around equities open, big green candle, we close above. In my mind, right, as if this market remains bullish, we're going to be closing above this. So I expect close above. If this is retracing, I'm thinking buying retracements. Buying retracements right here. So like I said, I'm long. I want to see it go higher, but it's just not giving me what I want. Now, because of how I trade and the rules that keep me from getting emotionally attached to a trade, when this or these two candles print and I'm bullish, when I go long here, I'm expecting a new high, firstly, because I'm bullish. And I'm expecting close above here, okay? I know. If we close above this candle, there will be something in the expansion here that prints a candle low above here, and that will set the stage for everything I want to see that's bullish. So I'm going to take this line off, give you some context. When I get that high, I'm trying to find the first candle low that is above here. Okay, so let me grab another line and go hunt for that. Bam, 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 bam. Here. In my mind, this is the area that should act as support and make a new high. Watch what happens. We trade through it, we close below. I'm not buying this candle. I'm buying this because it's all the way back down in discount territory. So I'm buying this candle and I'm watching to see if we're trying to get below here. We close above. When this closes above, I'm now expecting same conditions. Close above, pump, we leave. Between this candle's high and that candle's low, body's above that. What do you notice? No body's above that. As much as I want to see a new high, I am cognizant of the fact that I may be wrong because we are not following the rules that govern a bullish expansion. So I left. So that tells me I'm likely to be wrong. It doesn't say go short because I already have a bias. I don't like shifting unless an objective is met. Personally, that's one of my stubborn traits. If I'm bullish, buy side is not met, I'll see potential shorts, but I won't be committed to going short. I'll just be looking for what supports this idea. I just want to make a decision around that idea. Close above, looking for something. This is potentially something I would trade because close above, down candle, took its high, come back down, I'm buying. Now buy, it snaps up here. I'm looking for it to continue. Starting to go back, I don't feel confident if this is starting to close low. This should be rejected. Stay above the rejection body, go. So instances like that is what tells me that I'm wrong. And while that was a very general response, well, lies, it's a very specific response. If I'm being general, it's if I'm bullish, there are signatures that print in price that says this delivery is bullish. I'm trying to use those to tell me if I should stay on this side of the market or I should cut risk or should dial back. And likewise for being bearish. So that's what tells me if I'm being wrong or right. A lot in that to digest, so let's let that cook. More so on the psychologist side, is there any advice you have for staying grounded after having a good week? Whenever I have a good week, I tend to get overconfident, which causes me to slip in my patience and execution in the following week and take unnecessary losses. And I have to take a break in order to bounce back. I want to get to the point where I can stay consistent week to week. So, most persons might have like the perfect response to a question like that, but I don't, because consistency comes in many forms. Firstly, it's how you frame it for yourself. I used to think when I was younger that consistency meant being able to flip an account. That's what I thought it meant. If you can flip an account every week, you're consistent. Think about it. You put $1,000 in an account on Monday, take it to 5,000 on Friday, you withdraw, you start again. You keep going. If you put your target at 5K, then every time you hit 5K, check, done. Then there are the persons who are growth oriented, simply growth. You don't need money from your trading account. You're already rich. So you're just thinking about week over week, is the account net positive? That's one way to look at it. After every good week or every good account flip, I mess up. Right? It's part of the process. But I expect to mess up. So what I do is, first day back, cut risk. It's like trading on Mondays. Trading on Mondays, you know, you're coming into the week with your analysis on Sunday, your baggage from last week, whether it's a profitable or losing week, you're coming into Monday with all that. You're likely to make snappy, impulsive decisions. It doesn't mean you're a bad trader. It doesn't mean you have bad psychology. It's simply human nature. So you start, get like a rolling start. Cut the risk, trade whatever you see. Get the P&L vibes out of your mind. And then as you become more confident, size up. Or intentionally delay yourself. So let's say you usually start trading at 7 o'clock every day for some reason. After any type of streak, start at 8. You can still watch the market at 7, but just bring yourself back down. And you'll find a lot of times that many of the things that you would have rushed to do at 7 would have ended up being losing trades. And then 8 gives you that confidence that says, okay, that would have taken me out. You know, this is what I'm going to do now. And then same thing, build into a position. That's what I do. For anything else psychology related, get out of your head. Like vent on paper. Open the book. Don't even have to spell properly. Just write. Sick of this stupid trading stuff. Just write. Get it all out, and then you just dial back. And you go back to work. You think clearer that way. That's my opinion on that. In one of your original EO videos, we created a BPR starting from 4 a.m. and then we expanded outside the BPR. Created around the 4 a.m. EO. We then created an EO, and then you said this EO is the start of a delivery, so it will need an end, okay? Then we trace back the EQ of the BPR. You said that that specific EO's delivery is completed. So next candle starts a new one. What's different ways we can see an EO's delivery? I think this is a very old question. I think I've got this question before. If you look at deliveries having one of two objectives, liquidity or imbalance, then once the liquidity is taken, delivery is filled. Once the imbalance is filled, delivery is complete. And you start looking at it from once that's done, new delivery starts. That's it. The delivery is completed when the objective is met. The objective is either liquidity or inefficiency. That response is enough to get you to look at whatever is happening and make a decision around it versus looking at a specific example. If this is reaching for buy side and buy side is taken, objective is met. Objective is met. What do you want to see now? Well, for continuation, I want to see some support structure built. So down candles, CSD higher. If I think it's reaching into buy side to go lower, then once buy side is met, new delivery, what you want to see. Short-term buy side engineered, displacement, OLR, CSD, die. You start thinking about it like that, and then it's easier to find conviction versus feeling lucky when something prints the way you want it to, because everybody sees something that you want, but the conviction to hold it is what we lack sometimes. So think about it like that, and it's easier to find the conviction. It's easier to find a mile marker that says, you know, I could have impulsively sold here, seeing that, you know, I don't think it's going to go higher, etc., and then gotten all that beautiful drop. Or it's rejecting here, the bullish signature to continue close number of highs is not being printed. So what I'm going to do is find this high, look left for some sell side, any candle low that's before 910, use that to frame a DR. So high, left, low, fib here to here. On M1, That's my DR. And order block, premium, short, tops above the high. Looking to see the market break below here. You want the breakaway gap down there. So 39 to, that's a 39-point move to get outside of the range. Partial break even at 30 points or 20 points. I don't know. There is something. Stop the break even after taking partials. Who cares? But yeah, identify the objective, and it's easier to see when a new delivery is starting and when something is unfinished. That doji representation of a cycle ending or starting. I mean, as long as you can find a doji, you can also find the candle start a new cycle. So, I don't subscribe to dojis in the sense that they end deliveries. But if you spend enough time looking at M1 in particular, you see a whole other thing that print around dojis that will have you very, very skeptical about what they should or what they should do. But in my opinion, it's one of those things that it looks cool for a while and then it just fizzles out. But I haven't done any work on doji in many, many moons. So that's something that we're seeing in today's price action. It should be an interesting theory to test. Identifying expansion protocols, easy. I came up with this idea purely based on common sense, right? Like purely commonsensical. If a market is bullish and it's going higher, we will be closing above highs, not just wicking above highs. I am an M1 trader. So most times I'm looking at the M5 and the M1. On the M1, I don't necessarily need closures for entries because M1 is primarily for entries unless you're trading time. But I will be watching the M5 and using it as confluence while my M1 bias is playing out. And what I noticed is expansions or impulses that resemble an expansion get confirmed when we start closing above the highs. So we have up candle, we're closing above this high, then chances are, as long as we keep closing above that high, it's going to act as some type of support to push the market higher. Unless you're looking at midnight trading and then you're looking at this candle's open price. All right. So I'm looking for, so what I'm looking for is in bullish expansions, up candles that close above previous up candles highs. And I'm looking for retracements to buy into that move to make new highs. So let's say up candle, up, we're closing, retracement, I'm thinking to buy inside here to make a new high. You buy, it goes up, it's not closing above previous expansion, then I don't like it that much. I start feeling like I'm going to be wrong. I start micromanaging, take off, trim, whatever to justify or feel better about the trade. But yeah, those are expansion protocols. Similarly, in bearish examples, big down move, second down move, that low, need to close below that. There are instances when there is one-sided price action. So we have all this down move, down. It's some arbitrary level. I don't know what this is. Then we stop. It's always good to pay attention to when we stop closing below the lows and start wicking. So take a look at this move. Closing below, previous candles low, closing below. Right here. Inside here. Notice what happens. we stop getting down candle, closing below previous down candle lows. So now I can start using the price action here to frame bias. Okay. First thing I want to do, mile marker. This high is a mile marker for higher prices or internal target. We go down. Okay, no big deal. CSD, 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 CSD here. I'm long and I'm targeting here. I need to see them close above this. Need them closing above this to justify reaching into anything that's above here as liquidity. Pull that out in time. We close above. I'm okay buying this. Unless you're a big FEG fan and you want to look at this. But this is all back and forth wick, back and forth wick. So big FEG through back and forth wick, back and forth wick is not FEG to retrace to. Yeah. So higher, new high. We go. So once it closes, we're expanding. I'm not reading this. I'm not reading this. That's a lisp. Under the rules of bullish expansions, we need to be closing up above previous up candles high. We close above this, yes. We close above this, yes. We reach up, reach into liquidity, it's pulling back. I don't trust this so much. So now you start creating mile markers because we can't move price. When is the last time we expanded higher? This is where you're going to focus on. Can we close above this? Yes. Can I get a low above that? Up candle. Low. You must stay above that with bodies. Stay above, stay above. No longer bullish. There you go. How much data of forward testing do you do to fully trust the model or testing? Well, it depends on what the model is. If you're looking at a higher time frame model, then personally, I would just load up a daily chart, outline the rules, and just go at it until my eyes hurt. Personally. And when the chart stops, you go to the replay function and you push it back and you go back more. When you're dedicating time to study, just dedicate time to study. If you're looking at lower time frames, then you want to have an M5 chart up and you want to go through. You want to be able to isolate a segment of time. For me, 8 to 11, always. Isolate 8 to 11. The rules are the trade should form inside there. So I want the analysis prior to that, and I want to see that window reach into the liquidity because that's distribution. When they're distributing in 8 to 11, I need to see them reach for wherever the market was accumulated. And then wherever the manipulation took place should be air quotes protected high or low. Let that cook. Is every risk on a trade you take the same? Nope. You should know this. Well, if you did not know this, I do not apply the same risk to trading. None at all. I do not apply 1% on every trade. There are days when I personally don't feel like I'm in peak performance. Either I woke up late, I'm feeling groggy, or something. I just don't feel like my ideal self. I will cut risk on those days. Outside of that, I'm very aggressive. Very. Please talk about your journey. Like, how did you find the 84-minute cycle? Why specifically that number? So for the guys who are pretty old to trading, and you remember when ICT had Telegram, you're the old folks. There was a day he was trading USD CAD, if my memory is correct. And he said something about 90-minute cycles, and everybody went crazy. Everybody went crazy, right? If you spend time testing, you will find eventually that these 90-minute cycles are, not it. And then you'll argue, why would he say it? Why would he say 90 minutes if it's not 90 minutes? Then you'll remember what he says. I can get you close enough, but I can't tell you. So then you start playing around. You play around, you play around, you play around. until you start noticing things popping up, and that's why you journal. When you measure range and you measure stuff, how long it took, eventually numbers start popping up. And if you write them down, they will repeat in your journal. If they repeat in your journal enough time, don't fight the data. So I went on a curiosity spree. I went testing and voila. Shout out to CME. The kids.
Can we go more in depth on that one?
We could.
Do
It's a
you,
broad topic, so guide me. Where do you want me to?
you've stated before that that cycle is related to the fib sequence. Sorry if that's going too deep. You've also said that you can use said fib sequence to trade other timed cycles.
Mhm.
Do you care to speak more on how that applies?
Sure.
Okay.
So, like everybody who is a old ICD head, we have tried to use ICD's logo to decipher markets. Can I get an amen? Kidding. Right.
Amen.
Everybody has used ICD's logo to try to figure out something about the markets. I'm one of them. When I got obsessed with algorithmic trading and you start talking to people, you start bouncing ideas around, you start playing around with the Fibonacci. The more you play around with the Fibonacci, again, the more things are going to jump out at you. And the more you journal, the more you're going to see them. If you are convinced that there's an algorithm, then it cannot operate arbitrarily. Whenever a high is put in or a low is put in, there's some function taking place that identifies and references this data in the back to create that run, unless somebody's just punching the numbers, right? So if it's a function, it's a recursive function, which means it's creating something and it's referencing itself to create something new, and it's referencing itself and whatever it did to create something new. That's essentially what the Fibonacci sequence is. So let curiosity guide you. You play around with that enough, you start seeing things popping out. God forbid you start counting candles. Enough playing around with projections, you will start seeing the Fibonacci sequence pop up all over these highs and lows. The thing about it is, it gets really, what's that word? Elusive when you try to trade it without bias. It's like
Toxic.
it's like knowing that a high or a low should put in no, and the market is going down, and you're bullish, and you're like, is this a swing low? Is this a low I buy? It starts looking better in hindsight. And I've done extensive live trading with Fibonacci, where I will create indicators, identify where the turning point should form with time, and just play them. I've played beautiful examples where I call the expansion and the expansion comes right on time. I've played examples where I call the reference point and the expansion failed to get above the reference point, and I'm like, okay, any day now. So this would have been an example of one of those where I understand that once it gets above here with a body, it's going to run. All of this is just going lower, 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 and I take losses here. And then it goes up, gets above there eventually, this plays out. And I'll get this, but I'd lose this. But the confidence would have me sizing up on these to make it all back and more. Enough of that, and you start recognizing that something is wrong. If this is the reference point and I know what this means, either I'm chasing it down here, or there's something that should tell me that this is not yet ready. That's what Fibonacci lacked for me, And that's why I don't play around with Fibonacci much. That's why I mentioned I don't trade a model. I just trade my understanding of price. Because every model has specific rules that will say, this is the level. If the model is done properly, it should say, this is the model. This is what you look for at the key level. This is what certain things at the key level mean for directional bias. And this is what you want to enter once your bias is confirmed. Key level, the model would say, this is my key level. My understanding would say when it closes above, but then the trader in me is going to say, if I know it's going to expand above here, and I see down candle here in CSD, why am I not buying here? Right? You take losses that make sense. And it's very, very hard to isolate examples when it's going to work perfectly and examples when it's going to do this. So either you become a perfectionist and you only trade this part, and you leave this alone, which many people do, or you try to be better and you try to put other things together. Either way, you're going to end up the same place, realizing that there are perfect examples of perfect deliveries, and then there are examples that makes you go back to thinking that the market is hunting you. And it's hard to deny that it's not hunting you, especially if, let's say, you're trading this. This has happened to me many times, where I identify a level. It's trading through the level. I'm looking at getting in at a better entry. It's giving me what I want. I'm trying to size in. It stops me out. Then I stop. Then it starts to push. I miss the ideal entry because it moves away very fast. And then I'm looking at this now and I'm seeing not what I want, but what it's doing against me. Then you miss all that. You start chasing, you get something, but in your heart of hearts, you feel like this is horrible. You didn't trade it properly. So you can't change the rules of the model because the rules clearly work. What you have to change is how you engage with it. So you start creating risk profiles. Under these circumstances, I will be aggressive. Under these circumstances, I will cut risk. Under these circumstances, I don't have to use a stop loss. Under these circumstances, walk away. Those are the rules that you eventually create. But unless you're following like an indicator or trade signals or something, it's going to take a lot of hard work and a lot of experience to get to that point, or somebody just has to tell you. That's it. So 84-minute cycles, Fibonacci, I've used them to predict exact highs and lows. I've used them to predict exact turning points, but something about it had me demanding things. And then when you demand things from price enough, you start feeling like it's moving when you say so. And then you start sizing in, and then you start getting burnt. So as good as a lot of things are, you have to come back down to earth. And I kind of came back down to earth with Fibonacci. Not that it didn't work, but I needed to be a better person to trade it the way I wanted to. If that makes sense.
Yeah, thank you for that. Appreciate it.
Cool. Could you go over when to take an internal range trade? When to take an internal range trade? That question has so many things written all over it. I don't know where to start. What I will say is, if I'm going to take any type of internal range trade, I must have something that tells me or suggests we're not leaving this range, or we have to retrace before we leave this range. Typical range expansions. If I have buy side liquidity resting here and I'm trading 8.15, I love, like, this is something I love. This is my default read on price when I'm looking at 8.15. Buy side So let's put a line here for 8:15. Buy side run, some sell side or candle low prior to 8:15. Dealing range. There. That. I think this range expansion model is one of the easiest distribution profiles to trade. Full stop. A dealing range formed in liquidity pool on either M5 or M1. I don't buy this a lot of times. There are times I do. I can't tell you when to. If I was to put a rule to when to, it has to be the size of the range. If I can get 20 points from here above premium or just premium, then it's worth it. Otherwise, leave it alone and wait. If the liquidity pools are there, M5 low, sometimes I will short. If the bearish expansion profile prints here, I will short this to target the sell side liquidity, trim, wait for that, add, then add again in the breakaway gap. That's in Jamaica, we have this term where if you're talking to somebody about anything that's culturally expected, we will say that's a code, which means that's a code. Everybody knows that that's the road code, or that's the code to follow. If you're trading breakaway gaps in the morning and you're trying to go bearish in a pool of sell-side liquidity, shorting in the retracement after the breakaway gap, and shorting to the retracement after the dealing range, and shorting the retracement at the breakaway gap, that's just code. That's just something you look forward to doing because that's how they print over and over and over. If you don't believe me, ask God. That's another. If you're Jamaican, you understand that. But yeah, for internal range, that's what I look for. If I don't think this market is going to go outside of the range, I'm trying to frame equilibrium of something, and I will. No, never mind. Just trying to frame equilibrium. That's the best thing to do. Equilibrium tells you that this is where it should happen. You don't have to short equilibrium on a whim. Sometimes it happens, but you can just expect equilibrium to do something and then get in afterwards. If you're impulsive and you're quick and witty, short equilibrium, stops above here and your life is good. If you're not, try to think about it in terms of a process. If I'm right, just above equilibrium should reject price and push it lower. Once it starts to push lower, there should be something that say this is a bearish expansion. And if you were here when I outlined what I wanted for bearish expansions, you could start saying, once a down candle prints and we're closing below previous down candle lows, I will short into a retracement. If we're ever on a live call and you start hearing me say, I'm going to sell the next candle, it's because that's what I'm looking for. I see a down candle, I see the close, or I see that we're below previous low. I know that next candle is going to open, wake up and die. And I want to be a part of that instead of trying to be micromanaging. Those are when you follow the rules. But yeah, that's a lot to digest, but very, very good for discretionary traders. Ones that like to look at price, read it, feel it out, and then trade it. What I just said is a lot of what I've said so far should really resonate with you. Is there 8 more minute cycle for when? What? I could say yes to that question, sorry, and then that's going to spark another question. So I'm going to say yes, and it's not where you think it is. Yeah.
So
Is that
just-
a call?
is that just yes?
I'm here.
Okay.
Stop the
You know what I'm thinking about?
Yeah, stop it. Oh,
Good lord. But don't worry, I'll
nice to see some questions though. Some good ass questions.
yes. It's been a while since I felt like this. I feel like he's
Mm-hmm.
actually asking questions.
These folks are too shy.
I don't know why, man. I don't know why. Nobody's judging. All traders here, we all lose money when we lose money. We all make money when we make money.
Thanks.
Do you use a 50-minute time frame specifically for time retracements? The answer to that is universally known. No. I don't play around outside of M5, M1. I'll go H1. I'll go daily. But everything else just sounds cool. There's an element to M15, however, that I like. Right? This is what I like about M15. Once upon a time, ICT said that the M15 is the best bellwether chart. If you've never heard that, then you haven't been listening to ICT long enough, right? I went looking because you see so many of the old folks posting their M15 charts and like, wow, something must be on M15. What I like about M15 is it gives you a good idea of how the hourly chart is going to shift. That's all I like about M15 chart. If I'm planning to hold a very large move, once I'm in, instinctively I track on the M1 and M5 because I'm a scalper at heart. But whenever I'm trying to find conviction to stay in the move, I'll use H1 levels that we need to close below for expansions, and I'll use M15 for the structural shifts into the M5. It's more powerful, and it tells you when you can just sit down and stop trying to micromanage. So outside of that, I don't like anything else but M5, M1. First 34 minute cycles of it. 34 minutes of 84 minutes I use for expected window. So this is something, if you've been with me long enough, this is something that you just have to know. Like you just have to know this. Every cycle, every trading day, I don't know what the next word is, follows the same general structure. It's an algorithm. First thing the algorithm must do, the first thing an algorithm must do is create a range. It has to. So it works. If it's not going to create a range in a new delivery, it must reference one. Simple. Sometimes we're outside of the last range, so referencing it is irrelevant unless it's inefficient. So if it opens, makes a range, big run up, it will reference that because the inefficiency is there. But if it is efficient, then it left, and then it's efficient, we're trading higher in a new efficient range, it's going to create something inside here first. So you're going to get something like a range being created, then some type of move outside the range, and then at some point in time, it's going to seek to rebalance depending on where it is. I'm assuming it's up here, but let me not assume it's up there and do you something better. If that's the range, it's going to be seeking to leave the range here. At some point in time, it's going to be seeking to fill the orders up here. And that's not going to make a lot of sense to you unless you trust that the purpose of the range is to gather order submissions. It's to build liquidity. Let me say it like this. The range allows liquidity to be built above and below consolidation. Everybody's not, you know what, you've heard that before. It's allowing the orders to be submitted. Orders get filled, orders get settled. Game over. Orders are submitted, orders get filled, orders get settled. That's it. This is trading. Take away the technicals, take away PD arrays. This is what's happening. Orders are being submitted to be filled the next day. Orders are being filled the next day. Orders have a life cycle or a time cycle, T+2, T+1, etc., etc., etc. How long should this order stay in the market? different types of orders. Good till canceled, good till date, fill or kill, etc., etc., etc. All these orders are coming in the form of liquidity. They get filled, they get settled. You don't need to go into trading encyclopedia. Some settlement requires air quotes cashing out. I buy 100 million here, I sell 100 million here. You give me my money, game over. Some settlements, I buy here, I don't settle, I roll over because I'm pushing it into the next cycle. Wink, wink. Or I buy here, you give me what I want. I buy 1 million bars of gold, you give me my 1 million bars of gold. How am I going to store it? I don't know. That's a problem for me. So do I actually want 1 million bars of gold? So
I
you know.
would.
I'll take a few off your hand.
Well, yeah, that's outside of the technical stuff and all the pretty. That's what's actually happening. Orders submitted, they get filled, they get settled. For them to be submitted, there must be a range because breakout trading is the life of the markets, air quotes. Everybody wants to buy on strength or sell on weakness. So orders will build above and below here. Because orders are building above and below here, the market creates a range. Because the market creates a range, there's going to be an average price. Because there's an average price, you could identify where it is. That's it.
You still use average price if the range is inefficient?
Absolutely. That's, elements to a trade setup is called elements to a trade setup, in my opinion, for a reason. Once we're in a range and it's efficient, that 50% must come in play.
Oh no, I said if it's inefficient.
If it's inefficient, then it's all about imbalance. Imbalance trumps inefficiency in inefficient ranges. What? Imbalance trumps equilibrium in inefficient ranges, and equilibrium trumps imbalances in efficient ranges because there are no imbalances in efficient ranges.
Sure, yeah.
Little poetic. But yeah. All right, all good, Scotty. Scotty is a beast. Are you familiar with 12 bar cycles and H1? I am. And I don't like them. How do you identify the cycles? How do you use the 9 daily? So here's the reality. I had big plans for 2024. I framed out 2024 almost perfectly, in my opinion, and I executed terribly on it. It's an election year. I expected a big run up. I wanted to buy below the yearly open in January. January was bullish, so I got burnt pretty bad. I packed everything higher time frame related and throw it in a box and throw away the box and throw away the key. Basically, yeah, I'm no longer trying to be swing trader. I no longer care about long time frame. I'm just velocity. Yeah, so daily cycles, all that good stuff, fun, nice, cool, but I'm not interested. Midnight trading, opening price of the 3 AM candle. What is that madness? Midnight trading. Okay. So midnight trading firstly refers to the opening price at midnight. Secondly, midnight trading refers to a call that was done very, very close to midnight, in which we talked about expansion protocols. And the good folks in the group who like to name stuff call it the midnight call. So whenever I mention midnight trading, I'm specifically mentioning the expansion protocol that says if we're bullish, up candle, we close above, mark this opening price. Opening price of this candle. See that? Yeah, that. I have a problem with identifying imbalance in the range where there's buy side and sell side, like in a stop on range. Is the imbalance going to be the buy side leg if it was inefficient when taking liquidity? And this is what you call rebalancing. Oh, that question is time-based. I don't know if that's how I put the response into words. So you know how I say at 8:15 I start trading. So if $8.15 is right there. Let's say this is 8:15 and I'm interested to, I'm trying to put this in words, so bear with me and pay attention. This window of time is when I trade. Known me for a very long time. You know, I've traded 8 to 11. Even when I was trading 3-hour cycles, it's 8 to 11, right? This is the distribution window of the day. This is when orders get settled. And for the folks who know what settlement check is in the afternoon, you will understand why settlement check comes after the actual settlement. Anyway, moving on. This cycle, if you're tracking inefficiencies in this cycle, you start there. So let me say that again. Listen closely. If you are tracking inefficiencies in this cycle, you start here. If you are referencing inefficiencies prior to this cycle, you start here. Meaning, at 8:15, you must be able to look between here and here and identify where one-sided price action was done. It's pretty easy. Pretty easy. We started here. This is all up candle. That's inefficient. They need to put down candles that extend all the way back down to the open at that line. Done. This down candle went below here. So the inefficiency is now there. So they need to put up candle body through that range. Done. At 4:20, all of that is efficient. Textbook. There's nobody here that should not know this because we used to do this in 2023, like at the start of every call. Where's the inefficiency? Cool. Pull that out. That's your efficient price range. Every time we expand away from here, it will create an inefficiency. So, inefficiency, filled. That's why the fill is so beautiful, and that's why you can always track it. So, at this point in time, 4:45, there's some slight perfectionist. That's basically where the efficiency, the efficient portion of this market is. We expand lower again, between there and there, inefficient. So if you're tracking, again, pull that out in time. They need an up candle body back above that purple line. It's inefficient until that happens. Efficient. So now all of this, efficient. As long as we're trading inside here, this is not creating an inefficiency. You cannot create an inefficiency inside an efficient range. All of that is efficient. As we expand outside of that, here, all this green candles, inefficiency. So we know that there should be a down candle that comes back and fill there. Now, if you are a little bit versed in these calls, you know from the point of the last inefficiency to the body of the lowest down candle, that's where down candles need to be. So at 8:15, you're referencing this as your inefficiency. And if you're tracking inefficiency afterwards, then you could look at from wherever that is. So at this point in time, efficient market creates support and resistance, etc., etc., etc. Life is good. The rest becomes easier to see. So if I'm thinking that we are reaching lower to fill orders or to run liquidity sell side or fill imbalances, I know where I should trim. I know where I need bodies below. I know where I need bodies to stay below. I know where all of that is to help me stay on side. Here we go. If I think something is keeping this market from running away, then I can track the inefficiency inside here and identify where it should come back to and all that good stuff. Etc., etc. Same thing. There we go. So I hope that helps.
Can I ask a quick question involved in there?
Sure.
What are your thoughts? We spoke about it a little bit a while ago, but I just wanted to hear what you'd say again. For like the specific timed range, maybe we'll call it ONS. You get that first range that prints, it prints like a valid swing high and valid swing low.
Mhm.
There's like a couple schools of thought that have kind of evolved in there. Is like you maintain that first range or you let it evolve as it continues to print inefficiencies and fills them. What value do you think there is in either maintaining the first range or allowing the range to evolve as the time comes to an end of the timed range?
Good question. Good question. So I've always maintained that when I start trading, I need a look back period. Inside this period, I will continue to evolve the expansions so I could reference if inside here, the job of delivering the market efficiently was done, because the algorithm, that's its sole purpose, to deliver price efficiently. I want to know when 8:15 start or even when equities open start, what's unfilled, and I kind of add this to that. It is my belief that when the market has nothing to do here, it goes somewhere else. Simple. No fluff, no fancy words. When there's nothing to do inside this range, it will go somewhere else. That's why we expect the market to break out of efficient ranges. That's why we expect the market to retrace inside inefficient ranges. So I will evolve the range for trading here. There are folks who can't trade New York. They have to trade inside here. When you're trading inside here, it becomes your job to track where breakaway gaps form in relation to efficient ranges. And that's when you don't need to evolve it. So let me say that again. Let's start here. Inefficient, efficient. If this is the first range, if you start trading at 420, this is the range you have. So if you're thinking runaway, breakaway gaps, you're thinking about them in relation to here. So we know an FEG is going to stay open below this range, or an FEG is going to stay open above that range. If you're trading here, those are the parameters that you're using to keep yourself on side. So this big FEG here, short, target that. This is 82, 69. Maybe not a lot. If it's worth your while, then yes. Outside of that, just allow it. Then you do that. I personally don't like the idea of jumping the gun on things that you understand simply because you're too impatient to wait for it. That I've done it before. I don't like it. I don't like what it makes me feel, especially if like have you ever framed a bearish week and then you tried going long and then the market just runs, and every time it drops you keep thinking that I want to buy it up to sell it down, and it just keeps going. And then you're like, okay, so what kind of madness is this? What kind of madness is this? That's why I don't allow things like this to pull me into the market before here. I am 94% positive that I will not trade inside here. There has to be a reason for me to be up here. I'm sleeping. So
Happy or not at first. It won't stay, I see.
in regards to objectives being liquidity or imbalances and that making the delivery complete, can you comment a little on deliveries that leave in liquidity or imbalances behind, i.e. 9-12 cycle or 10-15 on 10-15? Okay, 1 second. Price never takes 9-12 EO high and leaves imbalances so the delivery as we crash at that specific point. Is this delivery complete and we no longer okay? So let's clear up the charts. 10-15 is Tuesday. So let's go back to Tuesday. It's at 8:15. So someone specifically mentioned 9-12 on 10-15. So let us take a look at that. This was the trade that Moan sent. He's on the call. 9-12 comes in. Huh. Let me do this for completeness sake, because out of the top of my head, I'd be looking. All right, I could open for 9-12, but I'm not going to kill anybody, even though I want to. Question: is there anybody who uses 9-12 here, as it are here?
Don't do this again, please. Oh my goodness.
No,
Wink.
I'm curious. I'm curious.
I use 8-12 for something else. You already know what it is. I will.
All right, let me.
In the English laundry video, though, if you guys go back to some ICT heads, if you guys are curious enough, ICT is putting on like 30 contracts at 9-12 or 10-12 UTC -4.
I'm not going to do that again. So let's say 9-12 here. I like referencing everything around equities open. That's why. So this market is breaking down. So I'm assuming your comment or your question is in relation to why are we not going back above here? Yes. Okay. So let's go to the M5 for a little bit. If we're tracking delivery after 8:15, all right, remember, we reference inefficiencies prior to 8:15 and we track them afterwards. So 4 o'clock on the dot is there. So there we are. So bam, 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 bam. At 8:15, the records show what is this? This is the inefficiency in the market. Any objections between 8:15 open to this down candles open there? That's inefficiency. So we need down candle bodies through here. Once the down candle bodies print at 8:35, all of this is now an efficient range. So you're tracking the delivery inside an efficient range. The good book tells us that in efficient ranges, equilibrium is king. There we go. So everything I want to see is going to be framed around that. So now let's go to the M1 chart. because I have my key levels. I can't just read price action without the key level. We know what happens when you do that. You make poor decisions.
Hope and pray.
So I'm looking for bodies, closures, breakaway gaps, everything that says we're not bullish in this environment. If we're bullish, hit M5, hit the equilibrium, new highs. That's important. So we hit, we trade up, we make a new high, we come down, we hit, no new high. First indication that this is not bullish, even though there are other things that would have told you it's not bullish. So that means you're looking for a breakaway gap at that red line. Some FEG should be printed after we close below liquidity pool. In this case, after we close below sell side liquidity pool, I need to see a FEG that stays open. So let's go. Relative equal lows, trade up, relative equal lows, we trade down. Let me take this line off. I'm going to find the liquidity pool here so I can identify when we take the liquidity pool and the FEG that should stay open. Liquidity pool, everybody's in agreement. Taken, FEG stay open, this is bearish. Iowa FED, ICD, Iowa FED is the name of the game. Or if you have the cojones for it, every time we open and trade above, you sell into that. Very, very dangerous stuff, I must admit. But if you have the breakaway gap and you trust that it's going to stay open, it's not as risky as you think, because you close, even if you don't have a stop, or if you have a stop, it's above the FEG. If you don't have a stop, you're closing above it if it goes above the FEG. If you have a stop, it's above the FEG. Open, trade up, you sell. Bam. Open, trade up, you sell. Bam. Open. Keep going until you get to the liquidity pool. And you probably don't know where liquidity pool is.
Oh, this is amazing.
Hey, know that voice?
I see you. I just finished job. I just finished working right now. I'm peeping the sauce. Hey, just quick question. Did you went over bag already?
I'm pretty sure we went over bag years ago, but there has been no questions. I'm just answering the questions in the chat.
In the chat.
Yeah.
Okay, no, I mean, I know you put it in the group how you identify the bag, but there's something about it that I'm not getting. Like that line that you showed that you expect the bag to form. Why did you pick that line?
All right. So if I don't remember when I did it. That's the thing. Akash is going to save me from the disorder, and we're going to put lessons in designated videos. But most of what I taught were in calls. Like everybody understands that we're just talking, and then the spirit just says, "This is what you teach today," and I teach it today. But for bags, we trust bags that form under these conditions. There's a pool of liquidity. Let's say here. And we go higher. We take the liquidity pool. So this is below that. So let's say it pulls back. We close below the liquidity pool. At that point, once we close below the liquidity pool, you want to see a FEG stay open. So logically, there should be two schools of thought around bags. School number one. If I have, this is a candle closing below the FEG, do I use that low and the high of that candle as my bag? And school of thought number two, which everybody should be able to anticipate now. Should I use this as the bag? What do you think? Curious.
If you pay attention to price enough, you'll see that the bags always form like when a mile marker is getting passed by.
Bag is going to be here.
Yeah.
So for a moment. Just pause, let this cook for a little bit. If I know this is where the bag is going to be formed, if this opens and it's above here, I will sell this because I expect this candle to be big enough to expand below this candle's low while allowing space for this candle high to reach up and not touch this candle's low. That's a whole bunch of highs and lows. But if you think about it, it makes sense. So if you've ever seen, I'm not gonna say if you've ever seen, if you remember when we're on live calls and we're watching candles, you know, sometimes we'll say, we want to see this candle move, we want to see the wick below here, we want to see trade below here, close below here. And then there are times we want to see, I want this to be a big candle. These are the instances where you can expect a big candle, air quotes. These are the instances where you can expect speed to come in, because the speed is what is going to create the big candle. Make that body all the way down here. So you can start seeing that. I think on the M1 on that setup, you could see that. Two ways to look at it, right? Like I was saying when I was talking about the bag, the DR. I love using buy side and a sell side from inside here to frame my DR. I just love doing that. It's just beautiful. If you don't subscribe to using highs above ONS and a low from inside to frame your DR when it's like this, use that to identify where your bag should form. Simple. I'm using this because of the benefit of hindsight. Because of the benefit of hindsight, I can see that after we trade up here, this is a sell side that we need to break below. If I don't have the benefit of hindsight, look inside here at 8:15. Let me take this off. At 8:15 here, give or take, that's a sell side liquidity pool. Once we wick this, right? Listen, once we wick this, so remember the drawing, remember this drawing. Scrunch this up a little bit. This is the liquidity pool, is that blue line. Once we wick that and take the liquidity, the next time we close, you want the bag to form right after that. You expect it. So you go back to here. The blue line is the liquidity pool. Select a pipette off. Don't kill me. There. Once we wick that, like we did at 9:10, you need a close below the 9:10 low there, and then you expect the back to form. So I'm gonna move this a little bit. Once we close below here, you're now automatically saying, based on the drawing, this candle's low and this candle's high is going to create a breakaway gap. Survey says breakaway gap.
What if that first candle is like the I'm on my phone. This is going to be hard to draw. See. What if this candle, there we go, is big enough and is creating an FVG also?
Then you're selling into this candles when this candle opens up and wicks up, like the drawing. This would have been the big candle. You're selling into this. I put this on the drawing for that reason.
Yeah.
But
then when you sorry.
Oh no, go ahead.
I was just gonna say, but then when we're thinking about first FVGs in the expansion leg, and are we gonna use that is gonna be the expansion leg because the dealing range forms, and then after that retracement we get expansion. And so if we have that first FVG that gets formed over here, like let's say theoretically the level is here, and then you have this wick here, and then you have this candle's wick and you get this body is big from that candle, and then the next candle prints and only puts a wick up here. But this is technically the candle that you would be saying the bag is at, but this is the first FVG in the expansion leg.
Mhm.
So you still use this one for narrative, even though it's not the bag, and then you still trade this candle's wick expecting this to be left unfilled?
100% every time.
Okay.
Ah,
That's why I put this on the drawing. There's no other candles here with the wicks except this one.
Yeah.
I put that there for that reason. This happens a lot. What you just outlined happens a lot.
Yeah, that's why I asked.
Yeah, the FEG might not always be there, but this wick up is going to be there, and that's what you pile into.
Yeah.
So here, the moment this candle closes, you now think we are going to get a bag. So your mind is thinking, I can sell into this candles as it opens and wakes up, sell into it, and expect this to be a big down candle.
Right.
If it doesn't print as a big down candle, no fuss. I'm expecting the bag. If you didn't sell into that and you see that the bag just formed, you're selling into this IOFED. And then it's just identifying what liquidity pool is. Here it is. This print often enough to trade it alone if you patient enough.
oh, so that's how you trade the bag, bro. That's why I always used to ask myself, how did he get these goddamn entries, man?
So if you've ever seen my charts and I have a line on them, like it's just a M1 chart and I might have like a red arrow or a blue line and that's all. It's one of two things. Either the blue line or the red line is a failed expansion. Well, three things really. The failed expansion, the start of the expansion, or where the breakaway gap should form. Anytime you see, look at any charts I've ever shared that only has a line on it. There's a breakaway gap just at that line, or there's an expansion running away from that line. You can anticipate where they're supposed to form, and then you trade if they do form. Sometimes you can, like I do, I trust them enough to see them coming under the narrative and enter like all the way up here. But you don't have to do that. You could use that to say, this is supposed to happen. It happens. You sell. You're good.
And very often, you don't get the IOFED into the bag
No,
because it's just like so bearish or whatever. So like the three kind of, can you zoom in on this? Because I'm on my phone. It's gonna be hard to draw.
here.
Yeah. Please, thank you. So kind of the three entries that you're outlining are the most aggressive because this is pre quote unquote confirmation is selling into that candle. As it manipulates up and does the buy side run of it. But then the next entry, technically, even though you're going to have larger point risk, you can always sell into the third candle of the FVG as it creates the wick, which is creating the FVG. And then kind of the beautiful part about selling into that is your stop is actually technically the low of the first candle of the FVG, right? Because you want the bag to form. So yeah, exactly, Mohan. So if you sell into the third candle, technically kind of your stop can be, you don't have to have a hard stop, but like your mental narrative stop is you don't want that third candle to come up and touch the first candle's low.
Indeed.
Okay.
For risk, you can also think about the fact that spreads exist. So try not to choke the trade too much.
Yeah.
Give it the room it needs, then adjust afterwards. You don't need to be, it's not the RR trade.
Yeah. Just yeah.
But yeah, for bags. So for the person who asked the question, if you look at the FEG 912, so I was really interested as to why the 912 didn't print. No, as in why they didn't take the 912 high, because that's essentially what you're asking. No, I see absolutely no reason for this market to trade above this candle's high or to its open. Efficiency first, then the breakaway gap narrative. Absolutely no reason for it to go back up there. So hopefully that helps.
Kish, why is this the liquidity pool?
First low prior to 8:15. When I'm looking at the DRs forming, look at 8:15, buy side, sell side. Liquidity pool.
Okay.
M1, M5, there's never been any issue deciding which one, just for completeness sake. Yeah, on M5 as well. So on M5, this is where you want the breakaway gap to form.
So basically, you're taking the first swing low before 8:15.
Yeah.
Okay.
This is the close. We're expecting the breakaway gap to form inside here. As I was saying, every time it opens and trades up, you could start anticipating that sell. Anticipating, and then it just breaks down. And life is good. Sometimes there is no lows in here like this, and it's just one of those comic book ranges where it's just one up move, one down move, and then you could use these, because the definition of the breakaway gap does not say swing low before 8:15. It says the liquidity pool taken and close below. This could be your liquidity pool, in which case you could look for a wick below it, then a close below it, followed by breakaway gap.
Hey, but it doesn't actually have to be a wick. It could be like a body close and then another body close then.
Yeah, I use wick because wicks are more common. The definition is liquidity taken and close below. This drawing over here, liquidity taken, then close below. So there's no body here while there's there's no box on this low, but I put a box on this low for that emphasis. Liquidity taken, close below, breakaway gap.
As you mentioned on M5, it's FVG.
Yeah. This is the one that Gentler was talking about. Sometimes this is this is what prints, and you have to understand that that's what it's doing and not try to.
I mean, on M5 is this, but on M1 we were looking, I think, somewhere lower here.
On M1 it was right inside here, yeah. So if you have the two time frames side by side, you're gonna have to make a decision. Seeing it enough times will refine your decision-making process.
Okay, so attaching the back question or the back logic that we have, how do you identify high probability FEGs? You just use the let's just say the run, and then let's just say the run to FEG, then fail the swing, and then another run, and then that's how you usually identify a high probability FEG.
So there are a couple of things that you factor in when you're thinking about high probability, air quotes, FVG. The first thing is, what are you trying to do? That's the first thing. Because some FVGs are used for reaccumulation. Some air quotes, FVGs are what you want to be your breakaway gap. Yes?
Yeah.
It is my belief that whenever the market is expanding, it's creating multiple FVGs. 1 second. Christian? Saw my son running away again. Two little fast legs darting across. Anyway, where were we?
Was it FEGs? Some of them are used as accumulation. Some of them are used as backs.
Right. So not everything with a 3-bar candle and the space in between should be seen as Well, I mean, you could call them FEGs, but don't expect them to do the same thing. Like some of them, like we've just shown, are breakaway gaps, so they should stay open. Some of them are reaccumulation. My study that I did, and this is something I've shared with you guys maybe a year ago or a little bit more. If there are multiple FEGs in the expansion leg, I focus on the second one for entry. Second one. When the market's expanding, it goes bag, then FEG. I want to sell the FEG. I don't want to sell the bag because I want the bag to stay open. So if this is an expansion, bag, FEG. I want IOFED inside here. I don't want them here. Capiche? That's it. Anytime there's multiple FEGs, I'm looking to enter in the second one. First one, bag. Think about, expect it to be a bag. Don't be surprised when it acts like one. Don't be surprised when it does what the MSS FEG does, where you close above it and then start acting as support. Don't be surprised. Those things happen all the time. This here looks weird, but if you look, you'll see multiple FEGs in some support leg. The first one, they close above it and it just starts acting as support. If you want to get a little bit more convinced.
So this is basically how you know you are in a let's just say a fast-paced market, or when we are in like a time distortion market, when the back like forms.
Yeah.
Gotcha.
Especially if it starts forming around like specific opening times. Just, yeah. Let's see what's the next question.
Hey, I guess I put a question like a couple of days ago in the group, but I'm sure you were a little busy. With the when the loop occurs, right? The next candle we use it as a directional candle, right? Or we can also use it as an EO.
Out of the top of my head, that sounds like a yes.
That sounds like a what?
Yes.
For which one, the EO or the directional candle?
It depends.
So let's just say we have an opening time. Let's just say a time EO. Let's just put 912, and that 912 open price, but it created a loop. So sell side and buy side liquidity, and it closed back inside or at the open price. And the next candle that opens after that, would you consider that a directional candle, or simply also, let's just say, EO?
That would be both of them.
That's both of them.
Yeah, that would be both of them. But then
that
using that information to trade is what's important. How do you use that to trade? If I have a directional, so let's say the candle in question is a down candle. Okay.
Yeah.
And let's look at it from the perspective of both bullish and bearish. So the candle is a down candle. We know if this candle is going to support bullishness, take its high CSD, life is good, we run. We also know if bearishness is going to come in and it's a down candle, we want to start seeing body closure below its low. So then you start using that to confirm, should I enter now or should I wait? What if it's a down candle and we wick it slow, we pull back, we close inside its body? Then I want to see the next candle open, take its high and drop. And that's a second time frame BR.
Yeah, I get it. Okay.
Indeed,
hope everybody heard that.
When you're compounding small accounts and pass, how was trading like risk management, and do you just aim for 1 to 2? Okay, I feel like so. First things first, I'm not the RR trader. I don't do 1 to 2. It doesn't matter what I say in any conversations regarding risk to reward. I am not a risk to reward trader like that. In terms of framing, like last week, I found out that somebody close to me is actually trading. Worst peer in the world. What's the worst peer in the world?
GU.
Lots of smart persons here. GU. He's trading GU in London. While I understand, I told him I want him to have a I want to have a conversation with him, but I'm not going to have it until April next year. Because I want him to, because he sounds very confident. And I've been there. It's GU, it's London session. We've all heard the rumors, big moves happening in London. So I told him, like, I hate GU from the bottom of my heart. And I'm never trading London unless I have a specific reason to. But you sound very confident. I don't want to throw you off. This is my number. April next year. Hit me up, let's talk. While having like a very brief conversation, he was saying, I missed a beautiful 1 to 3 this morning. I'm like, oh, that's going. I didn't know how to feel about it because I didn't know how many pips it was. And we're all about how many pips it was. It was a 5-point stop, a 15-point target. That's a 3-to-1. But who cares, really? So I kind of told him that I'm not into the RR stuff. He's telling me about his mentor and all that. I'm like, oh, see you in April. But anyway, I don't trade RR. It's actually like my response to this is very, very funny because I was talking to somebody yesterday. They were asking me, why do I still study and why do I still review and stuff? And I said, I think I'm at the point now where the only thing I need to focus on now is money management. I feel like my technical analysis is good. I feel like my risk management is good, but I feel like my money management is not where it needs to be. So, yeah. And this is what I've been doing, which is what we're essentially trying to redefine and coach me into all that good stuff. So I'm in school now for money management, air quote school. But nonetheless, on my live account, every time I open a trade, I know how much margin, or I pay attention to how much margin is held to maintain that position. Because of that, and I look at like margin percentage and all that. Because of that, I know how I can size into trades and I know what the dollar value is for the lot size. So if my last account flip was 2 weeks ago, it was a $106 account and some cents, whatever, some cents. On that day, I took 3 trades and they were all 0.5. So $106 allowed me to open 3 0.5 positions. That's essentially $5 for every 10 pips. Okay. So times 3, that's $15 for every 10 pips. I got 20 pips or 20 something pips each and closed the day. No, that's a lie. Because I closed the day at like 200 and something. I don't remember. It's on a little bit. But I think I got like 80 pips. If it's not, I think it's about $40 each on each trade. That's why I was confusing. I got like $40 each on each trade. That's about 80 pips each. And that pushed the account like 200 something. Then the next day, I went a lot of trades actually, but there was a lot of 0.5 trades and then scaled in with like one lot as the day progressed and ended something like 600 something. So because I don't pay attention to RR, I'm looking at a setup and I'm thinking, okay, this market is likely to expand at least 50 points or maybe 100 points. I'm trying to capture 50. If when the market is at 50, the signatures in price is not showing me like sustained continuation. I'm not getting the close below. I'm getting wicks below. I'm shaving heavy 80%. So on a 0.5, I'm shaving like 0.4 and leaving 3x 0.1s to run. And then if it retraces and I get something, I'll add those 0.5s back and then compound it like that. So I pay attention to what I can make from the setup. I don't want to over leverage on a $100 account on a move that's going to give me maximum 20 points. If it's a perfect trade, I get 20 points. I don't want that. I want setups I don't want to say over leverage, right? I want to say setups I can go in based on the account size and based on the purchasing power and let it move with me. If ever the market is doing this and I'm heavy in a position, I get squeezed. So I try to avoid that as much as I can. I try to avoid markets that don't move. If I get caught in a market that's not moving, I might take some losses and then I'll take some wins, or it might be a messy day for me. But I don't do RR in that sense. If you're going prop, anything under 50K, I think 5 lots is decent for a NAS position, and you can scale in 2 or 3 times depending on what the price action looks like. If you're going above 50K, then I feel like 25 lots is the way to go. If you put 325 lots in a position, that's $750 for every 10 pips or 10 points. So if you're using a 50K account, 20 points is giving you $1,500. That's 3%. If it's a 100K account and you do the same thing, 325 lots, 20 points is giving you 1.5%. That, I feel like that's a sustainable habit, given the fact that our stop losses generally are small. So if you actually lose that, you're losing 1.5 because it's 20 point stop. Unless you go more than that and then you're compounding. So I personally like that approach to risk management, and I try to adopt that as much as I can. So not RR, and I only do FTMO. I haven't touched another prop firm in quite a very long time. I lost a lot of prop firm accounts from account, not including the one that I lost emotionally, but I've had a few times where prop firms went under and I was not paid. So kind of, yeah.
You shouldn't have taken so much money from them then.
If only I had done something else with it, eh?
Okay, so why don't you go with the futures platforms? I think they're
where I live, they don't like me.
okay, yeah.
Don't like me at all. The 1, 1, 2, 3, 5, 8. Good for time. For fib, yes. We talk about art, when and how to apply best. Any day, any time, any range. That's a simple answer. You could use art anywhere.
Hey, so Kesh, I have a quick question. The DR that you say, how do you frame your DRs again?
I don't think there's only one way to frame DR.
No, yeah, no, I should have reframed that question better. Just a quick example for me to see, because something about it I'm not getting right quick. Because I don't actually use it. I use simply ranges.
Okay.
But I use the ranges, let's just say efficient or inefficient ranges, but I don't quite actually know, or I didn't study properly enough how to identify the DRs yet. That's why, because I'm trying to master everything little by little, not throw everything in my mind all at once.
Perfectly fine. So I'm a firm believer, because I've been trading for a while and I've been led by both curiosity and bad information. I try to have everything defined. So what separates a dealing range from a regular range? ICT did a very good job at explaining this in one of those videos that I don't remember what it's called. I'm trying to remember if it's a purge and revert, but I can't remember at this point. Purge and revert was a beautiful video, by the way, if it's still up. He explained that a dealing range is going to be a price swing. This is all ICT. This is the basis of how I frame dealing ranges. A price swing that ran buy side and sell side is a dealing range. So if you have, here's one. This is a dealing range right here. This price swing here has a run below buy side and a run above sell side. This is a dealing range. ABC. There we go. Same thing. This, the one end of the price swing is below sell side. The other end is above buy side. That's a dealing range. That's the difference between like this. That's a trading range. That's a trading range. And that's why when I'm looking at 815 DRs, I specifically have one run above ONS and one run below a low in ONS, and vice versa for bullish conditions.
And you say the trading range that you mentioned above there, why is that a simple trader? Because you don't see any run above when that run high, you don't see any that it took any high or something?
So if you look at this end of the range as a run above buy side, then this needs to be a run below sell side.
Yeah.
I don't see that here.
Okay.
Maybe that one is arguable, but you get the idea.
Shane,
Yeah,
I wanted to touch on trading ranges as well. How do you identify a high probability trading range? So, for example, like I've been back testing like which trading ranges to use versus other ones, and specifically, what I've came a conclusion to is that if liquidity is taken first and then a trading range is formed, that one is always high probability.
Ooh, nice question.
That sounds very sexy. I'm looking up in the sky like a chess player right now. That sounds very sexy. Bum, 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 bum.
You got it. No, you got it.
So I'm in a little bit of a pickle answering that question, and I'll tell you why. Okay. If you had asked me this question last month, I'd already be explaining my answer using overnight session, runs on ONS highs and lows, and beautiful. However, due to my recent epiphanies, ONS has moved down my list of high probability stuff. And if you know ONS is pretty good.
ONS is amazing.
ONS is amazing, but what I have come across recently is mind-blowing.
He has new sauce.
ONS look like it makes ONS look like support and resistance.
You gonna really do us like that?
Yeah, like trust me. That's what it does. It's essentially this. I'm able to understand stuff I was trying to understand years ago, simply because I saw my journal. I'm like, whoa, disgusting. So
2025 mentorship or what?
No, no mentorship or anything. No mentorship. No mentorship. So what you don't see on this chart are these two indicators that I've built, and they are doing an absolutely disgusting job of pointing to the daily drawn liquidity. I think it blew Moan's mind last week.
You had to mention my name, right? And everybody will message me.
oh Lord. Yeah, but it's just roosters are saying that I should wrap up now. But anyway, yeah. I don't know.
So you just gonna dangle that carrot in front of us like that, though?
No. So the point of me saying that is, like I said, for his question, if you had asked me that before, you'd have already got my response. But my confidence level in the response I would have given you has dropped. So I'm not going to give you that because I'm not going to tell you something I don't believe in. Essentially, I'm not that type of person.
Right.
So yeah, I'm telling you that. The answer to that question is something that, or the answer I want to give you is something that I haven't given you So I can't talk about it because it's just going to be misleading or carrot dangling, and I don't want to do that.
Mm.
But essentially, my opinion right now is that AMD, in the sense of orders being submitted, filled and settled, is like 99% clear. Like 99% clear. Like it's jumping out at you. And you can see where it's supposed to be. So all of this month, all of next month, all of next 6 months is going to be me grinding with this. Grinding. I need to recondition my mind from ONS to this because I still see ONS stuff. And I want to recondition my mind to this to make it. Yeah. So
Press the button. Press the button.
yeah. Like I did a month on paper trading with it, and the results is what pushed me to say, you know what? ONS gotta go. Got to go. So
Send me those indicators.
But that's
based
a
on
hard
ranges
pill
then?
to swallow, though.
that's what I'm saying. I can't honestly answer the question the way I want to. So I want to tell you that I'm not answering the question for that reason. Instead of tell you something.
What I'm saying is just based on ranges.
Yeah, time and range.
Okay, so it's like, ONS is broader.
No, ONS is insignificant.
Oh my lord!
I'm telling you, it makes ONS look like support and resistance.
Damn.
But
does it still incorporate 84 minutes?
Nope.
Keep it
Does
to
it
yourself.
incorporate unseen
Open the
voids?
start, and you see where the orders are. You just target them. Or
Yo, just stop.
give me some time to get over whatever it is I'm going through with this newfound knowledge, and we will have some fun.
Yeah. Hey, listen, if you gotta keep it to yourself, just keep it to yourself, man. Give it to your children.
You're fine.
You gave us enough.
You're fine. You're fine.
All I can say is that you guys are in good hands.
No one said it. Could you give us some advice on when not to anticipate a need for a swing high or swing low to be printed above and below timely use? That question is directly related to the question that was asked about what's it called again? The 912 question. Or that bag eliminated the need for anything to go back above the 912 open. That's it. When the structure is clearly showing you that it's either expanding or breaking away, and there's no need for the micro stuff to take over when the direction is already clear and the structure is already clear. That's very vague, but if you were here for the 912 response, that's the answer. That first push higher is accumulation of the buy side liquidity that needs one more push above. I think that's in relation to something that's already gone. What's new on what? I'm part of a Telegram group. I'm joining. So we changed from Patreon to WAP for a management reason. WAP was just better in terms of back end stuff and management. Yeah, that's essentially it. There's a live call that you did, and he was watching the swing high and low of the 748, and you watched the close outside and said the PDA should form here. Can you expand? Or very detailed. Oh, that's something else. That's essentially what I was trying to show you when I did the expansion and the high and the low above it. So I put a whole lot in this call subtly, but you will see when you rewatch it. The expansion definitions and the conditions under which you see that it's expanding, and how you frame where it should stay above or below, that is something that you should not take lightly. It's very, 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 very useful. Very, very useful.